Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 34 on November 4th, 2018, and I'm your host, Eric. In this week's show, we will cover the trades from last week on Hertz Global Holdings, Teva Pharmaceuticals, and the VanEck Vectors Oil Service ETF. And we discussed three new trades on Petro Brasil, the QQQ ETF, and Mylan Pharmaceutical Company. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here on the show or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel, the channel for the Weekly Option. Now, this week, the market was up a little more than 2%. The Dow Jones Industrial average rose 582 points last week, closing at 25,270 points on Friday. The S&P 500 index rose 64 points last week, ending the week at 2,723 points. Now, there are 1,289 publicly traded companies here in the U.S. that will announce earnings this week. Among the huge list of companies announcing are Eli Lilly, CVS Healthcare, Penney, Redfin, Delek Holdings, and Targa Resources. Now, let's dive into the trades from last week. So our covered call was on Hertz Global Holdings, symbol HTZ, Harry Thomas Zebra. The stock was trading for $13.48, and I looked at selling the November 14 call at $1.10, hoping to collect a 12% return in 3 weeks. Hertz stock rose $1.27 per share this week, finishing at $14.75 per share. The November 14 call that we sold is now in the money. That means that the trade worked, and if prices stay here or higher, we will be assigned on the option at the end of the November expiration month, which is in 2 weeks. The goal of this trade was 12% return in 3 weeks. Well, we got the move in essentially 1 week. So if you're still bullish this stock and really want to compound profits, here's a couple of suggestions of what you can do. You can buy back that November 14 call which you sold. Now, you'll pay $1.90 for the Nov 14 call, taking a loss of 80 cents. However, that frees you up to keep the $1.27 you earned from the long stock position. This creates a net profit for the week of 47 cents, or roughly 3% gain in the week. Now, from there, you will sell the November 15 call for $1.30. So given the $1.30 we will collect from selling the November 15 call, plus the 47 cents net profit from the loss in the option, but the gain in the stock, and then tack on the additional increase in value of the stock from $14.75 to $15 a share, that's a 22% return in the next couple of weeks. Not bad for a 3-week trade using stock and an option. Now, the next trade that we looked at didn't fare quite as well. We looked at a credit spread on Teva Pharmaceuticals, symbol TEVA, Thomas Edward Victor Adam. Stock was trading for $19.70, and we sold the November 20.5-21 call spread at 15 cents. Now, this trade moved against us big time because Teva Pharmaceutical stock rose $2.89 per share over the week. That quick movement put our short call spread in the money, and it's actually priced at 47 cents right now, which is 94% of the total spread value. Total spread value is obviously 50 cents. So at this point, we need to consider playing defense. The total loss on the trade so far is 32 cents. Now, I would look to sell a put spread below our original strikes. However, those spreads are only trading for around 3 cents right now, so that won't work. I'm also tempted to sell a call spread and a put spread to collect some premium. However, selling a higher strike put creates a situation where you can lose money on both trades in the same down move. you're already short an in-the-money call spread. Now you would also be short an in-the-money put spread if the stock really were to fall. So the price chart hasn't fully convinced me that the previous trend is no longer intact. So given that, I'll stay in the trade another week and just keep track of the price rather than adding any additional trades to this position that could end up doubling or significantly increasing the amount of risk I have on. The final trade from last week is a debit spread on the Vectors Oil Services ETF, symbol OIH, Oscar Isaac Harry. When we looked at it, the stock was trading for $21.14, and we would have bought the November 22 21.5 put spread for 31 cents, looking for a 61% return in 4 weeks. Well, the oil ETF dropped 45 cents to finish the week at $20.69. This means that our in-the-money put spread is even more in the money. So right now the put spread is trading at a value that doesn't totally reflect the drop in price, but the price will adjust quickly in the next 2 weeks, leaving us on our way to locking in a 61% return. Now, the biggest thing to keep track on this upcoming week or this week is actually the midterm elections. We can definitely expect some volatility, especially if there is a significant change in the majority in the House or the Senate. So you can look at sectors like defense and infrastructure if we see an increase in or a continued control by the Republicans in both branches of the legislature. And if we do see a Democratic, the blue wave happen in the House of Representatives, then I would look at things like healthcare companies and other companies that will benefit from a more Democrat-based agenda. Now, the trades for this week, the first one is going to be a covered call on Petro Brasil, symbol PBR, Peter, Brian, Richard. The stock finished Friday at $16.13. I'm looking at selling the November 16 half call and collecting 67 cents, hoping for a 6% return in 2 weeks. Now, the way you enter this trade is by buying Petro Brasil stock for $16.13 and then selling the November 16 half call for 67 cents. Our next trade is a credit spread on the QQQ ETF. QQQs finished last Friday at $169.38, and I'm looking at selling the November 173.50 call spread for 16 cents with a maximum loss of 34 cents because it's a 50-cent wide spread. This is a 2-week trade. Both of these are actually all 3 trades are in November. November expiration is in 2 weeks, November the 16th. So you enter this trade by selling the 173 call, the November 173 call, and collecting $1.94, and then buying the 173 half call for $1.78. This is a credit spread because we are selling the spread ultimately. And this trade makes money if stock prices stay below $173 per share. Our final trade for the week is it's a debit spread on Mylan, a pharmaceutical company. Symbol is MYL, Mary, Yellow, Larry. The stock finished last Friday at $31.68. I'm looking at buying the November 32 put spread for 35 cents with a maximum gain of 15 cents or a 43% return in 2 weeks. Now you enter this trade by buying the November 32 half put for $1.90 and selling the November 32 put for $1.55. Now this is a debit spread because we are buying the spread, and this trade makes money if stock prices stay below $32 per share. So that's it for the week. Sorry for the speedy nature of this show. I'm recording it late, so hopefully you guys can have a listen, and I do apologize. I'll make it up to you on next week's show. I'll figure out something. But that's it. I hope you have a great week. Happy trading. Take care. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.